Welcome everyone to today's webinar. The topic is driving voluntary carbon market expansion, the rise of the use of market data and price benchmarks and the evolution of this market. Welcome to our expansive XSignals webinar. We are the market data arm of the expansive business. I'm Andy Bose. I run that area of XSignals, and joining me today are Henry Haggart, our market analyst, and Will Graham, our product manager. And we're excited to talk today about the evolution of the voluntary carbon markets and what people can see with respect to that evolution and what's driving the continued growth in this market. So to set the scene, if we talk about the voluntary carbon markets, we're seeing an exponential growth in these markets. For us at Expansive, operating the CBL spot exchange, 2019 was a banner year. We saw almost 10 million tons transact across the exchange. We saw almost $10 million of notional value transacted, and we had almost 40 participants on that market, which at the time was a really exceptional result for the business. But what we've seen in the last 2 years with the increased interest in the market and the increased needs for market participants, we've seen it just an exponential or beyond exponential growth in what's happening in these transacting markets. For us ourselves at CBL, we saw in 2021 a growth from that 10 million tons to over 120 million tons transacted across the exchange. We saw the notional value, and we continue to see the notional value being transacted across the exchange grow by a factor of more than 100. We may be close to $1 billion transacting across the exchange this year. And we're also going to see that growth in the number of firms participating in the marketplace, growing from just under 40 to we would expect to see about 180 firms that are participating by the time the year end. So what is this? What's happening? What's driving this change in the market? Well, what we would say in the discussion today that we want to really cover is a number of elements. The first is probably very significantly important. The voluntary carbon market itself is fully realizing all the aspects of a mature commodity market structure. If you look at agriculture markets or energy markets and the way they operate, we'll see in our discussion today that we've really achieved a very similar, in fact, almost identical structure in the voluntary carbon markets, which means that people who are trading in the markets are able to do so on the same trusted, verifiable basis that they can do so in other markets. The other transition that's occurred is that instead of having a marketplace that has been supplied traditionally by individual projects and then buyers who are trying to filter their way through every individual project, we've seen the emergence of quality benchmark price references in the market that allow people to either achieve their economics using those benchmarks themselves, or else to manage their economics based on differentials to those price benchmarks when they want to make an economic decision. And we'll go through what that's looking like right now. And then the last piece is kind of a virtuous circle effect. The more transactions that are occurring in the exchanges and in this fully matured marketplace, the more data there is, which is increasingly empowering better decision making, both for trading, but also for risk management or other functions that new entrants into the market are looking for. So that's really going to be the discussion today. Hopefully, we cover a lot of ground that's helpful to you. So when I talk about what does a matured market look like, the voluntary carbon market has followed a path that is very similar to what we would have seen in the 1800s in the agriculture markets, 1900s in the energy markets, and now in the 2000s in the 21st century around environmental markets. In the earliest days of any of these markets, there is a marketplace. There are identifiable buyers and sellers, but it's very difficult for them to find each other. There tend to be intermediaries that provide services so that they can find each other, but the pricing in the market tends to be very fragmented and opaque, and the ability to find each other is really representative of a fragmented liquidity. We can talk about how that was in the VCM. We can talk about the next transformations that occur and what happens when you're in a fully matured market. So we'll go through each piece one at a time. So in the earliest days, we had the UN crediting mechanisms, the CDM. We had developers in emerging economies generating projects and offsets. And we had buyers in developed countries who were looking to offset their exposures in the market. And those transactions can occur on a bilateral basis. But as I said before, they tended to be more difficult and needed the help of an intermediary to affect them. There was also a rising demand for more projects into the marketplace and different kinds of offsets. So we also saw the rise of independent standards bodies and registries in the voluntary carbon market. You'll know them as Verra or Gold Standard, CAR, ACR, and a number of others. With the advent of these registries and standards, we also had the advent of people being able to generate economics on a bilateral basis to agree on a forward contract and to take delivery of an offset when it came out of a particular project. But again, this was done very typically on a one-off basis with an extended discussion around what the value of a project offset might be with all the various quality elements that might be associated to that project. This lasted for quite a long while, and what we saw happening was a search for transparent data so that people could really understand what might be going on. But this is an actual example of what was available to a market participant back in April of 2020, just 2.5 years ago. This might be everything that they could derive of all the transactions that were going on in the market. Might be 4 trades that they could get. They might be able to see the country and the vintage associated with the project. But if you can see in the middle column on price, the price could be anywhere. It could be 46 cents, $1.25, or $7.50. And as a participant in the market, you needed to understand why. Why were those prices being achieved, and why were those prices being transacted? So we then kind of can come into what is the transformational moment in the market. Typically in most markets, what you'll see is the advent of a liquidity platform with the ability to trade in the moment, the spot market trading. You'll see the advent of additional data becoming available in the marketplace. You'll see the delivery now more and more of impartial spot pricing and forward curves, and the ability to see liquidity pooling into one venue, which means that buyers and sellers have much more choice and much more ability to affect the transaction that they want to. In the voluntary carbon markets, one of the first platforms or combination of platforms that allowed that transformation to occur were the CBL spot market for voluntary carbon, and as well as the EMA portfolio management solution that allows you to manage all of your positions once you've made either an acquisition of a set of offsets or you're ready to sell them. These two pieces put together really allowed the market to interact in a dramatically different basis. Instead of phone calls to each other or other mechanisms of communication, there was a centralized screen that brought all the information together. So you can see here an example of what that centralized screen would be. You have the selection of various different registries, project types, regions and countries. On the right-hand side is all the various different project sellers who are offering into the marketplace. On the left-hand side in green is all the various different people who are looking to purchase into the market. A really important moment in this market was the deliverability and guarantee of performance when you effect a trade. And so the way that this was handled here at CBL is that anybody who's selling into the market put up 100% of the offsets that they were looking to sell into a trust. And then anybody who was looking to buy from the market put 100% of the cash up, again, held fully in a single position. And then when they matched, you were guaranteed that the offsets were going to get delivered and the cash was going to get delivered over to the seller. This really created a very different mechanism for people to interact. As well, the capabilities of this screen allowed very fast types of filtering. You could filter on the registry, on the project type, the region, and the vintages, at least, among many other elements that you could filter on. So what you got then was not only the ability to transact, but because we were able to collect all of that data in the exchange, we were able to deliver that data into the marketplace as well. That powers a series of analyses that you can do either in your own spreadsheet or through using analytical tools. And as we get further into the discussion today, we'll talk about the types of analyses that people started to perform at that time, and then being able to deploy more of their capital into the marketplace. If we fast forward now to that opening chart where I talked about 2021 and 2022 and really the dramatic change in how volumes are being transacted and the notional value being transacted, we've really hit a moment where we are replicating in the voluntary carbon market, the same kinds of things that we're seeing in those other traditional commodity markets. We had the rise of standardized contracts that bring together certain qualities of various different offsets into one standard that can be evaluated. We have the ability for people to take the pricing that comes out of the transactions of those spot contracts to write longer term bilateral deals using the spot price as the mechanism for those transactions. And then really in a moment of additional maturity, people who have to really hedge their future positions in a market will often be looking for a futures market where they can do that. And we also now see that there's a very liquid futures market operating in the voluntary carbon offsets, and we'll talk about what that looks like today. So really the rest of the discussion today is around what it looks like to be in this matured state. The three contracts that we're going to talk about are typically known as the N-GEO complex. We've launched these three contracts at CBL over the last 2 years. The first one, the N-GEO, Global Emission Offset, launched in October of 2020 or just before then. And it was the first contract that found a standard of quality that an industry association had said would meet their standards for offsetting. It was the airlines industry, the CORSIA standard, and the N-GEO is a trading contract that brings together offsets and projects that are eligible under that CORSIA standard and can be transacted on our screens. Following that, the market realized that it would also want the ability to do the same kind of thing in types of projects that might not be covered under CORSIA. Very particularly, people were looking for nature-based offsets and a price signal for them. So we launched the N-GEO, which is a nature-based contract that has a certain set of minimum quality requirements that make you eligible to deliver into that contract. And then finally, following all of that, we launched the C-GEO, which is very similar in many ways to what we launched originally with the N-GEO. However, what it additionally adds is alignment to the initial set of core carbon principles that have been put forward into the marketplace. And obviously, as those continue to evolve, we'll have the ability to continue to evolve the C-GEO. But the idea here is that there are now 3 tradable contracts in the marketplace that represent standards that people in the marketplace are looking for when they're trying to discover value against those quality levels. So we launched those onto our exchange, and for the first time we could see transactions that were really oriented around the fundamental value of those quality standards. So you can see that there's both a set of sellers on the right-hand side of these charts. You can see in this particular case, on this particular day, the N-GEO had upwards of 10 to a dozen sellers in that market. 4 buyers. The N-GEO had about an equal number of sellers and buyers on that particular day. And you can see the number of transactions on the right-hand side that had occurred. So now you had a venue where people could really express value for the quality standards and levels that were associated with a typical class of of contracts that met those criteria. This has become a really extraordinary success, these spot contracts. What I'm showing here on this page is a couple of things. The first thing, the blue bars in the chart represent the volumes that are transacted absolutely in these standardized contracts. So you can see when we first launched, we might have seen 200,000 or 300,000 tons trading in those contracts on any particular day. In September last month, we saw 6.1 million tons transacted across those standardized contracts in our marketplace. The green line shows basically the overall percentage of what's transacting so the green line is the percentage of all the offsets that transact on the exchange. That percentage is the percentage that is coming through the standardized contract. So when they first launched, there was kind of a wide range of how much percentage was there, but right now we're seeing between 40 and 50% of all transactions in the market transacting using those standardized contracts and the reference and benchmark pricing that comes with them. So what does that look like in practice? The left-hand side of this chart represents the time before the standardized contracts were launched. You can see that each blue dot is a transaction that occurred on the exchange. You can see that there were a number of blue dots, but the price dispersion was really difficult to understand why on any given day one project or the other might be pricing the way they were. With the launch of the GEO, which is the green line, the N-GEO, which is the white line, and then the C-GEO, the yellow line, what we've seen is that there's, first of all, as I said, 40% of the market is trading into those three contracts. So you'll see that a lot of the volume is just concentrated into those three contracts. Then there are still individual projects that are trading, and they're trading around these new price segments that have been put into the marketplace. So the C-GEO represents one quality level in the marketplace, the GEO represents another, and then the N-GEO represents another one. So at this time, it's easy for someone to be able to go into the data, understand what that data is showing, and then do an analysis as to why something might either trade at the benchmark price or trade at a differential to it. And when I turn it over to Henry in a few minutes, he'll show a study that he's conducted that can show some of those relationships between what's on the benchmark and then how people might be trading any single individual project. Before I turn it over to Henry, though, I just also wanted to talk about the additional features of the current structure in the market. The current structure in the market has three components to it. As I've talked about, we've got the standardized contracts that have been launched through expansive CBL market. But we also have two of the most important players in the commodity markets interacting around these three benchmarks. We have the CME group, which is the biggest futures market in the world, having listed their futures contracts for this GEO, C-GEO, and the N-GEO. And then we have an interrelationship with S&P Global Platts, which is the biggest price reporting agency in the world. And what a price reporting agency can do is really surveil everything that's happening in the market, understand where prices are moving, why they might be moving, report on that, and very importantly, put out additional price assessments into the market that uses market information, but may answer questions that are additionally important, even if they're not directly transacting on the market. How does that relationship look? What we have between the three groups is the ability for us to share data and then to be able to manage our customers' physical exposures altogether. So the graph here shows that data comes both from the CME and from the CBL spot exchange into Platts. Platts is able to assess that information and on a daily basis put out assessments of the market that represent what ends up being the market close for us in the spot market, as well as the settlement prices for the futures markets on every day. The futures markets settle to a physical delivery once a month. When that happens, the CME figures out what all the various positions are for people who are either looking to deliver into that physical market or take delivery from the market. They send that information over to us at Expansive, and then we manage all that physical delivery through the construct that we have in that EMA platform that we talked about before. What's very interesting about this is that you can find many kinds of direct parallels in this structure with other markets that are trading, for example, in the energy markets or in ags. So it really puts the power of three different groups together who are each specialized in what they do, but combined create a lot of value for participants in the market. So just an example of then what happened as that complex came together. The CME listed the futures around the GEO family, and they listed it about 6 months after we listed the spot contracts each. And it's been a remarkable success for the CME and for the market in general. We've seen, again, exponential growth in the markets in terms of, on the left-hand side, the number of contracts that are trading on any given day. One contract here represents 1,000 tons of carbon. And then on the right-hand side, we can see how people are hedging into the market. There's somewhere between 15 and 25 million lots of open interest, 15 to 25,000 lots of open interest, which represents 15 to 25 million tons out there. So there's people who are putting in positions now to either deliver or receive into the future. And that's really part of the overall complex too that people are relying on. So at this moment, I'm going to stop my part of the presentation. I'm going to hand over to Henry, who's going to go through the data and really show how people are using that data to make their different kinds of decisions. So Henry, over to you.
Thank you, Andy. Thanks for walking us through some of the exciting developments that we've seen in the market over the past 24 months. For everyone who didn't hear earlier, my name is Henry. I work with Andy on the market data team here at Expansive, and I'm a market analyst. I'm responsible for a lot of the reports internally and externally that contain and report on exchange activity. What I want to talk about for the next few minutes is how the benchmarks have affected the market outside of what actually trades through the benchmarks. As Andy sort of noted here on this slide previously, there's pretty clear indication based off the transactions that having CBL, there's clear price signals that are coming from these benchmarks. But obviously on the right-hand side of this graph here, we still see lots of transactions that are taking place that are not going through the benchmark itself. So what we're going to do is kind of zero in on some studies of the N-GEO actually and see how the N-GEO has affected pricing in the market outside of the contract itself. Something I want to point your attention to again here is this graph that Andy shared earlier. As we've seen adoption of the standardized contracts pick up in the market, we've seen increased volumes and an increasing amount of the share of the volume that is traded through CBL comes through these contracts. But I want to highlight that even recently, when the portion of the volume going through these contracts has peaked, it's still only between 40 and 50%. So this means that a majority of the volume that is trading through CBL is still coming through on a project-specific basis. It's not trading through the standardized contracts. So one of the first analysis we did on the data with benchmark and all the trades that are happening outside of the benchmark was to look at projects that are N-GEO eligible but aren't transacting throughout through the contract. What we find is some really interesting developments in the last 16 months in terms of how the market is using the prices from the reference from the standardized contracts. Over here on the left-hand side, what we're looking at is the N-GEO price, close price charted in blue against all of the eligible credits that are transacting through CBL. On the left-hand side of this, back when the market launched or the standardized contract launched, what we see is that a lot of the transactions of N-GEO eligible credits were happening, around or near where the N-GEO was trading. But what's happening is that there's a lot of transactions taking place above the N-GEO. There's, a lot of transactions taking place below the N-GEO as well. And what we see is sort of time has progressed over the last 6 months, and really especially in in 2022 is that now we're in a state where a majority of the transactions of credits that are N-GEO eligible are taking place at premium to the benchmark itself. This trend is really clear over here on the right-hand side of this graph, or on the right graph. What we're showing here is all of those transactions of N-GEO eligible credits, but we're zeroing out what the N-GEO close price was. So really what we're looking at is the basis that all of these credits traded at to the N-GEO. Again, on the left-hand side, what you see is a dispersion of pricing above and below the benchmark. And actually, interestingly, last winter when the market peaked and the benchmarks really took off up to, I guess the N-GEO took off to near the $15 range. It looks like the benchmark itself was, the N-GEO itself was actually outrunning a lot of where people in the market were pricing the project. So we see a lot of transactions that were actually clearing at discount to the N-GEO. And then again, over the last 6 months, what we see is that vast majority of the transactions that are taking place of N-GEO eligible credits are taking place at premium to where the N-GEO is. And to us, this is truly indicative of what actual benchmark pricing looks like. It appears that people in the market are pricing N-GEO eligible credits at a basis to the N-GEO. What I mean by that is that, you know, if you're pricing at basis to the N-GEO, it means like, okay, a market participant who has N-GEO eligible credits might say that, you know, I think that my credits have a particular value that can earn me a premium to the N-GEO. So what the benchmark is really, I guess what the standardized contract is really effective at doing is allowing a market participant who has credits that are eligible to say, okay, on any given day, I'm going to price my credit at the N-GEO plus $2, plus $1.50, whatever they think that premium is. And you know, in some cases, if they have a credit that's similar to the N-GEO, but it doesn't actually qualify, you could even price a discount to the N-GEO. So again, over on the right-hand side, it's pretty interesting. All these credits that can trade into the contract aren't necessarily coming through the contract, but they're still earning like pretty significant premiums to the benchmark itself. In some cases, $4 to $6 higher than where the benchmark, the N-GEO is right now. The good news is that with our market data, we have full transparency, we have a full understanding of all the credits that are trading through the platform, and we know all the specific attributes about what project types they are, where they're generated, and so forth. So one of the things that we decided to look at is see if there's a correlation between the basis of these eligible credits and region. So on the right-hand side here, we sort of broken down all of those transactions of N-GEO eligible credits and sort of identified which ones are coming from Africa, Latin America, and Asia. And just kind of looking at this distribution here, as we see over time, throughout the graph, there's sort of an interesting mix of transactions. It's not necessarily clear that any particular region is gaining a particular premium over another. Now, I want to clarify that this is only for the specific set of N-GEO eligible transactions. And each of these transactions, each of these trades, all of these credits have other attributes that are affecting the price and the premium or discount they're achieving to the N-GEO. So one of the other things we decided to look at was how the vintage of the credits are affecting the basis to the N-GEO. And what we found is a pretty strong correlation between vintage and the premiums that participants are earning in the market, that these credits are achieving in the market. Over here on the right-hand side, you can see in the last 6 months, there's a very clear delineation between credits that are older vintages, 2016s and 17s. They're trading closer to the benchmark itself, whereas younger vintages, 18s, 19s, and 20s, are achieving those higher premiums to the benchmark. And what you'll see historically is that hasn't necessarily always been the case. So if anything, what we've seen in the past few months is that the pricing from a vintage perspective has become stronger in terms of actually influencing the value of credits. What's interesting is that this is sort of coming into line with price indications that we're getting from other parts of the market and specifically the futures market. If you look over here on the left-hand side, what we're looking at now is settlement prices from the N-GEO futures contract that trades on CME. What we're graphing is the settlement prices of contracts that expire. I guess we have the spot contract, and then we have the December expiry contracts for the next 4 years that are on here. And those ones are typically the most liquid contracts, and they're definitely the ones that have the most open interest or open positions. And what we can see based on the futures curve and the future settlements is that there's a clear preference for some of these. I guess the contracts that are settling in later years are settling at much higher values. And part of the reason of this is because the N-GEO contract has a mechanism where every year the oldest vintage that is eligible for the contract rolls out of the contract, and a new vintage is now eligible for the contract. So because of this, the futures curve is helpful in pricing some of these newer vintages, younger vintages that have eligibility to deliver into contracts further down the road. And what you see over here on the right-hand side, I've actually taken all the 2016s and 17s and made them the same color. Both of those contracts will actually roll out of the N-GEO eligibility in July of 2023. So the December 22 contract is the last one that they're actually eligible to be delivered into. And then you can see the 2018s, they are achieving a certain premium a little bit higher to the 2016s and 17s, and 19s and 20s are really getting into the $4 to $6 range. And both of those contracts, the 19s are deliverable into the 24s and 2020s into the December 25s. Really what this is indicating to us is that the futures market and the spot market are coming together and working effectively together to help provide transparent pricing for the market, which is not something, historically, if you look back in 2020 through 2021, we weren't necessarily seeing those clear relationships. So what I'm going to do now is I'm going to pass it over to my colleague, Will, who's going to run you guys through some of our analytical tools and show you how we're using market data from CBL to provide analytical analysis.
Great, thanks, Henry. So as mentioned earlier, I'm Will. I'm the product manager for our data team. I'm excited to give you an overview of our data and how it may be used, but I also just wanted to take a moment to highlight some of the stats on its granularity. As a data team, we're downstream of CBL, which Andy established as kind of the world's largest voluntary carbon spot exchange. And as the data team, it's a great place to be. 96% of spot exchange transactions in the voluntary carbon market happen on CBL. And in just the past 10 or 11 months, over 80 million tons have traded on a project basis and across the GEO complex combined. On this project by project trades, we've seen 240 unique projects from Vera, Climate Action Reserve, the American Carbon Registry, Gold Standard, and Eco Registry. And those combined combined with the vintages, that's 450 project vintage combinations. We're looking at about 10 trades a day with near constant markets on the GEO complex instruments. And one of the most powerful pieces of the data coming out of the exchange is that CBL is made up of a diverse ecosystem of participants. We have project developers, we have corporates, large banks, large commodity merchants, and also credit traders that have been in this industry for like 20 years. So the data coming out of CBL is really rich, and it's a unique resource in the voluntary carbon market. I'm going to share my screen now, Henry, if you don't mind. So I'm just going to be interacting on our dashboard here. Look, so back to the map, we are on project type all. So now we're in Q1. But yeah, we don't need to dwell on this too long. I just think this is a very quick and easy way to kind of look at the regional differences between countries through time. It's pretty clear when you go energy based. You can see this kind of decrease in volume weighted average price. I'm going to go back to our charting page here. I think one of the common pain points in this industry is more from a risk management perspective. if you are, looking at your specific position in specific projects, it's difficult to stay up to date on pricing of those projects just because the liquidity is broken up across projects through time. What your specific project that you may not have traded in the past couple weeks or months. And so one way to solve for this is to make a basket of similar projects. And one of the simplest ways to do that is to look at project type and country through time. And so we're looking at Brazil here. You can see that well-established premium of forestry to energy. We can also toggle over to China. The forestry premium stays. Is actually interesting here to see waste management is trading at very similar levels to energy, but still at a discount to forestry. Another way to look at it is kind of the inverse. So here we're looking at a big number of projects. I'm going to deselect some of them. We're just going to look at India, just a subset. So Thailand and Turkey are great to compare. They're often in the same conversation when it comes to energy projects. I think it's important to keep an eye on kind of the fluctuations between the two. From a similar perspective, we can switch and we can look at forestry projects in China and Indonesia. And this will follow kind of a similar trend to the N-GEO as well. One of the things I want to touch on very quickly is kind of this important new development in the carbon markets, which is the advent of ratings. So we have the B0 carbon rating and the Silvera rating, and these are integrated with our price feeds. It's still early days for the ratings in these markets. I think it's going to be super interesting to see if correlation between the rating and the price develops. This isn't something that we've seen quite yet, but it's definitely something that people are looking into in our data set. I'll also just note quickly here that we only have the letter ratings. For the full product, you have to go to B0 or Silvera to see all the analysis and research that's done. So this is really just the tip of the rating iceberg. And finally, before I hand it back to Andy, I just want to talk a little bit about some of the metrics around the GEO and N-GEO prices and volatility with value at risk on the right. If you're holding a spot position in these, super important to keep an eye on the price fluctuations and volatility on a day-to-day basis. It's also super important to watch these. If you have a position in the futures market, the spot market and the futures market for the GEO and N-GEO and C-GEO are explicitly linked through the settlement methodology, where the futures contract, the front month of the futures contract settles on the spot at the end of the month. So towards the end of the month, as the settlement date is kind of approaching, we see a lot more attention on the GEO and N-GEO spot prices. But in any event, I think these graphs are super cool. They're like, you see this big spike in both the GEO and the N-GEO kind of in late February, early March. And that was the Russian invasion of Ukraine. And so that led to that huge de-risking event in the energy markets that the carbon markets were severely affected for. I think it's just very cool to see in retrospect so starkly the effect it had. You'll also notice kind of at the end of this graph, just yesterday, we had this uptick in volatility corresponding with some sell side pressure on the markets. And that's kind of the last use case that I want to talk about is just this monitoring the prices on a day-to-day basis. We see especially kind of front office traders super sensitive to the daily fluctuations in price. And that's a great way to use this as well. We have yesterday's prices up here. So for the SIP contracts, the GEO complex contracts on the left, and the voluntary contracts on the right. Great. So I'm going to pass it back to Andy now. Thanks for sticking with me through the technical difficulties. I just want to reiterate that this is a great place to begin to answer some of the questions you may have around how the voluntary carbon market is functioning. But to do a really deep dive, the raw data that powers these visualizations is your best bet. And it's a really powerful and unique tool in this market. So thanks, Andy. I'll pass it back to you to close it out.
Hey, well, thank you very much. Thanks, Will, yourself for persevering through some of those technical difficulties. We did get a lot of notes that it was difficult to hear the first part of what Will had covered. So if there's any questions as to what he might have covered, we'll certainly look for any feedback or questions, and we'll put up on the screen here. I don't know, Henry, if you can do it, just the page that shows how best to get in contact with us. But really the intent today was to cover a couple of major pieces. The first is that we are seeing exponential growth in the voluntary carbon market. We think that growth is supported by the advent of these benchmark contracts and the ability to manage your economics using those benchmarks. And as well, we're seeing the ability to take the data that's in the market and really interrogate it for different characteristics that are important to anyone who's really trying to manage what their commitments have been with respect to their maybe 2030 or 2050 environmental commitments. One of the things to think about as we leave is that there are a lot of discussions often in the marketplace as to whether or not there are reliable and transparent price signals in the marketplace, and we would suggest that we're beginning to see those. In fact, we are seeing them now, whether it's the GEO, the C-GEO, or the N-GEO, each one representing a different basket of quality criteria that can be utilized for assessment. And then there's a lot of questions often as to whether or not there's enough transactional information in the marketplace for people to make specific decisions. And again, what we would say is we'd welcome any conversation along that as well, because we think that more and more we're starting to see that price transparency at an accelerating rate. Before we go, we did get a series of questions that came up in the chat. So we're going to try to cover some of them. The first one is a question that came in that talked about how open is CBL to developing different types of contracts in the market. Are the three that we have right now going to be the ending one? And very particularly, are there other contract types that could be put forward that might reflect different types of technologies, newer project vintages, et cetera, that might trade at a premium to what we're seeing in the GEO and the C-GEO today? The short answer is yes. We are absolutely willing to be looking at listing additional contracts. We take inputs all the time with respect to what market participants are looking for. And we would be very happy to engage that discussion, talk about the types of things that we are looking at, and what the next contract or contracts might look like when we go forward. I know in past sessions that we've had around this topic, things such as soil sequestration, blue carbon, and then newer tech removals have all come up as concepts. So for the person who asked that question, we'd be certainly happy to hear your thoughts and incorporate that into our product development thinking. Another question that came in was a question around these benchmark prices, right? Can we explain how that benchmark price is created? The short answers are that, as I described, there's information that is occurring in transactions on our screen. Those transactions are all guaranteed performance. They are absolutely how the market is trading. We take all the information every day, transmit it over to S&P Global's Platts division, who assess that market and provide a closing price back to us at CBL that we then post up on our exchange. That closing price is the basis for those benchmarks. Essentially, people look at those closing prices and then try to make sure that they're able to utilize that when they conduct their economics. I think the next one might be oriented towards Will. Are there forward curves available on the expansive dashboard? Do you want to answer that?
Yeah, thanks, Andy. So we do not have the forward curves on the dashboard. That's a CME and Platts product, actually. So we daily have the daily trades of the SIP contracts, as well as kind of all the voluntary prices, but not forward curves.
Some of the questions that have come up are very specific, and I guarantee we'll come back and talk to the people who are specifically asking. One of the questions here is, do we split AFLU into various subcategories? At the moment, we do not as a transacting contract. So the N-GEO is the nature-based contract that we have. There is probably at least some discussion as to whether or not we would create basis differential contracts to the N-GEO. That's still a discussion where we would really look at the demand for that type of contract versus potentially something where Platts could put out a daily price assessment that talked about the pricing in each of the subcategories. Let's see, there's another question that's come up. Are we seeing a trend in demand for each of the different types, the GEO or the N-GEO or the CGO? I'm going to turn that over to Henry if you want to just kind of provide maybe a fact base of where we're seeing the transaction volumes as of now.
Yeah, I mean, I think in terms of demand, well, I guess in terms of volume, we definitely see most of the volume is coming through the N-GEO contract. It really fluctuates on a month-to-month basis in terms of what's cleared through the contracts. Obviously, like, volume isn't necessarily reflective of demand, though.
Okay, here's one that I'd like, do you guys hear me? I'd like to try to answer, but I'm not sure if I'm going to get it entirely. It's from an anonymous attendee. How do we ensure quality for the N-GEO contract? So for each of the contracts that we have that's listed on the exchange, there's several elements that talk to kind of how you can have assurance that what's being reflected in the contract is what you would expect. The first is the spec of the contract itself is available on our website as to how the contract's defined, how it will operate, what's eligible for delivery into the contract, and a number of other really important things in terms of the logistics of how to interact and interoperate with the exchange and transacting the contract. Along with that, because every single transaction on the exchange requires that whatever's being sold is put up 100% into our system before it's allowed to be offered into the marketplace, we're able in our market operations team to review what's being put up for sale, assure that it meets the criteria for the contract, and only then allow that to be offered into the marketplace. And then also on transaction, we guarantee that that's what actually got delivered across. So as long as the spec of the contract is very clear, as we published it on the exchange, then you can know that anything that's delivered against that spec is going to meet the spec. Maybe the last one we'll do before we end off is probably a pretty interesting one. Do we see price convergence happening with the compliance market at some point? And I think that's an interesting question, particularly if we want to think through what at some point might mean. We're definitely seeing that there's a price discovery going on in the voluntary carbon markets with respect to the commitments that companies are making, and the kinds of price and quality factors that they're using in order to partially meet whatever those commitments might be. Over time, we would expect to see that. Yes, right. That as the credits continue to operate in the market, you'll see presumably an increasing price range for the voluntary carbon market that might start to match up against compliance. But they are very different mechanisms. The compliance market is a legislated mechanism. It's got different factors for what drive availability and supply. and it has different factors for what drives demand. So it's not necessarily, in my single person's opinion, true that they're going to end up matching up, but there's certainly going to be different regions in the world where they're starting to take a look at inclusion of the voluntary carbon market offsets into a regulated regime, and at that point you could probably see additional convergence. But I'm sure everyone who's on this call has a point of view on that. So thank you everybody for your time and for coming to attend the presentation today. We've got our email up on the screen here. We are absolutely happy and eager to take questions from anybody else who wants to engage, and we're looking forward to that. And beyond that, everyone have a wonderful day, and hope to see you or talk to you soon.